Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Do you have to pay taxes on the insurance money you get for a totaled car? This is a really common question, and dealing with taxes is the last thing you want to worry about after a car wreck. The short and simple answer is almost always no, you do not have to pay taxes on that insurance check. The IRS generally doesn't see this money as income. Instead, they view it as a reimbursement. You lost something of value, your car, and the insurance payment is just making you whole again by compensating you for that loss. It's not a profit. However, there is one major exception to this rule, and it all comes down to something called a gain. You only have a potential tax situation if your insurance payout is more than your adjusted basis in the car. For a personal vehicle, your adjusted basis is basically the price you originally paid for it. Let's use an example. Say you bought your car 3 years ago for $30,000. It gets totaled, and the insurance company determines its current market value is $19,000 and sends you a check for that amount. Since the $19,000 you received is less than the $30,000 you paid, you have a financial loss, not a gain. That $19,000 is not taxable. This is the reality for the vast majority of people, since cars are depreciating assets. A taxable gain is rare but can happen, usually with classic, collector, or heavily modified cars that have appreciated in value. Imagine you bought a vintage car for $25,000, and over the years it became a sought-after model. It gets totaled, and its appraised value is now $40,000. If the insurance company pays you $40,000, you have a $15,000 capital gain, and that gain is potentially taxable. But even then, the IRS gives you an option. Under a Rule 4 involuntary conversions, if you use that money to buy a similar replacement vehicle within a specific time frame, usually 2 years, you can defer paying tax on the gain. So, if you take the full $40,000 and buy another collector car, you likely won't owe tax. One final point to clarify is sales tax. While you won't pay income tax on the insurance money, when you use that money to buy your next car, you will have to pay the state and local sales tax on that new purchase. That's an entirely separate tax. This information is for educational purposes only and is not legal or tax advice. You should always consult with a qualified tax professional about your individual situation. Thank you so much for watching. If this video helped clear things up for you, please hit the like button and subscribe to our channel for more straightforward answers to your financial questions.